record this session. I will take this opportunity to record this session, good people. And right, so let's see what we have for today. I'm just going to take you through a sample of topics of your syllabus. Here it's not going to be the entire syllabus or anything. And even the detail, okay, I'll be detailed anyway. You start crying. So let's see where we start today with your studies. We're just here to assist you guys to go through your studies. There's nothing else, and pass your modules. Okay, so let's see where we starting. Okay, right. I'm gonna share my screen now, and we'll go through this. So this is a free class, right? You're free to ask any question. Mahala, not paid, right? So we're gonna go through this. If you want to continue with us, we're going to share forms which you complete and you join our classes. If you say, these guys, I think they know nothing, you're also more than happy to continue the shopping, Telegram or wherever there, until you find a tutor that suits your needs. But I will try to make things simpler in a way that even the slowest learner under the sun can understand what we are trying to achieve. All right. So I'm going to take you through your module, which is your financial accounting that you registered. So you have to know your syllabus. What is it that you're going to be tested on at the end of the semester? Because we are not doing this for fun. We're not doing this for TV. At the end of the semester, you're going to sit down and write an exam. And in between here, you're going to be writing some assignments. So it should be what? Focused. Our approach is to make you be able to tackle the assignment and tackle the exam without any assistance. Because if you seek external assistance there, you then become your institution's friend, right? Disciplinary pending. So you rather come for classes and get to know things on your own and get to be able to do things on your own without the assistance of your friend, because your friend will get you into trouble and you end up completing your degree in 2040. Sure. Now, this module, good people, is financial accounting. If financial accounting is a principle-based module, so we are being guided by principles. So there is a book of principles somewhere that tells us what to study. And that principle book is referred to as the IFRS book, or the accounting standard book, which you already know about, I believe. Maybe you've got friends that maybe at some point in time they were studying or CTA, ITC, and whatever SACA exams there. You used to see them pulling those big books. Unfortunately, you guys, you are growing in the wrong era of online learning. Back then, when we were still studying at libraries, you see the people carrying those big books. So those big books are referred to as the IFRS books. They contain the principles, they contain the standards of accounting. So in this module of yours, you are beginning a long journey of studying accounting. So accounting really starts at your second level. It really starts with this module, because this is where we then go through that whole book there. You're free to buy it there and study it on your own not during your spare time, because that is our syllabus. Okay, so you're really starting that journey of studying that big book. It contains different standards, right? If it's 80 all the way to whatever. So now what they do at this level is that now for your next coming 3 or 4 accounting modules, you are going to say now at each level, you're going to study certain accounting standards of that book. You go to the next one, you add more until you go to your APC exam, which is your SACA exam of becoming chartered accountants there, continuing to be studying these accounting standards. So now what is important for you to excel is that now, wherever you are, whatever year you are in, you must know what is in the syllabus. In this year, what are the accounting standards that we're going to be studying? Right, so we're starting there. So for you guys, you're going to be studying the following accounting standards. in this term. Oh, by the way, it's a term module in this term. So you are going to study IFRS 18. This is a new accounting standard. Right, let me try to mute there. You are going to start to IFRS 18. This is a new accounting standard, isn't it? Your friend is not going to teach you IFRS 18. They don't know it. It was introduced this year. If you ask your friend there by the corner and say, teach me this accounting, they are likely to leave out IFRS 18 because they don't know that there's been a new standard that has been introduced and it is part of your syllabus. They might teach you other standards and stuff like that and forget IFRS 18. Then come exam, come tests, is Okshaya. Then you go and fight your friend. There are things that you didn't teach me which came. I'm not campaigning, but I'm telling you the truth. I'm not saying come to me, I will teach you though. But I'm saying if ever you have to go somewhere and ask to be taught, remember to tell that person who's teaching you that, hey, there's a new accounting standard, IFRS 18. I know that during your times, you did not do it. Then they can research and say, oh, okay, so what does it say? Then they can then get to teach you. Right, in this module again, you are going to do UIS 2. Okay, IFRS 18. Okay, let's go back a bit. IFRS 18, it looks at presentation and disclosure in financial statements. Right. This standard was previously referred to as what? Previously referred to as IAS 1. Right. So our IAS 1, good people, has grown. It has matured to become known as IFRS 18. So IAS 1 and IFRS 18, there are some differences. There are some new things that are found in IFRS 18, which were not there with IAS 1. So this standard, as the name indicates, it will tell us what are the presentations and disclosures that should be done in the financial statements. It will lay out the structure of profit or loss. It will give you the structure of the financial position, structure of the statement of changes in equity. Let's not be big-headed and say, oh, previously I did another accounting module. I know how my profit and loss looks like. Uzoliman, the format is since changed. So that's what we're going to learn then in IFRS 18. So for you to succeed, good people, in your studies and in life in general, be someone who is seeking knowledge. Don't come here and say, I got 88% in my previous accounting module, I got 92 in that other one. It doesn't work like that. At each and every stage, we learn something new. So if you come with that approach, it can be a problem and it can cost you big. Because one is easy to say, if it's 1 and 18, it's still the same. Still the same. No, they are different. Okay, then you've got IS2 there. IS2, good people, it looks at your inventory. Right, IS2 is going to teach you about inventory. Inventory is a very significant line item in the statement of profit or loss, unless if you're a service provider. So IS2 there is an accounting standard that we are given by IFRS. It tells us how to account for inventory. How do we treat inventory in our books? How do we disclose inventory in our books? So we are going to humble ourselves and go through that standard and get to know how to account for inventory. We're not going to say how inventory is trading stock, right? Am I right? No, it doesn't work like that, good people, when it comes to learning. We need to humble ourselves. Come from the angle of, I don't know, what does this standard say? We go through it together. At the end of the class, then we say, okay, so that's how it's done. That way you would learn. All right, sharp. We are also going to look at another thing that is in your syllabus. It's your IS10. IS10, good people, it looks at events after the reporting period. Events after the reporting period. So let's say your year end, it's 31 December as a company. It doesn't mean that by the 1st of January, the financial statements will be available. No, it takes time to compile the financial statements. So it can so happen that now your financial statements are going to be ready by 28 February. they will authorize for issue by management by 28 February. That is 2 months after year end. So this standard IAS 10, it is going to tell us how do we account for events that will occur between our year end and the date that the financial statements are authorized for issue by management. It will tell us that. It will give us how do we account for those events. So what are we going to do? We are going to humble ourselves again and go through our IAS 10 and learn. Because if you approach it with our big heads and say this should be easy, this is only mad. I'm not going to lie to you, good people. Education wants you to be humble. You can't go into the exam and write things that you had been discussed in a taxi. I had them discussing IAS 10 in a taxi when I was coming for this exam. It's easy. It doesn't work like that. Humble yourself, sit down, study, write notes, listen. All right, let's go. There is another standard, IAS 16, good people. IAS 16 is going to look at, we are going to look at property, plant, and equipment. How do we account for property, plant, and equipment? So we're not going to start at window level. I'm going to explain to you what is property, plant, and equipment. Sure. After I've understood that, then I take you to the next level. How do we account for it in the financial statement? According to what? IAS 16, they will be guided.
Yes.
So 1 to 2 things that got in order. How do I mute? Okay. Let's see how I mute 1 or 2 people there. All right, Asambe. Next. Okay, IAS 16 there. We're going to learn. Right, we continue. Also, as part of this syllabus, you need to go through your IAS 37, the accounting standard. IAS 37. So IAS 37, what are we going to learn in IAS 37? You need to go through this standard inside, you read. You might not have to buy the book per se. Let's say I'm poor, for instance. Let's say I'm poor, but I want to study IAS 2. I'll go to my Google then and say IAS 2 download. They are going to give me the extract of that standard. You see there, they are. I go to download. I have my IAS 2 inventory. How do I account for inventories? I dive inside. It's 14 pages, good people. In 14 pages, you can read and finish it before you sleep today. By the end of the day, you'll be knowing your IAS 2 as much as I do. Then you can even claim that I'm better than him. He failed to explain this. I understood it better after reading for myself. I can even teach it better than him. 14 pages. You humble yourself, take a break from TikTok, download this standard, you go through it, They are going to define for you what inventory is. They will tell you what net realizable value is, what fair value is. They will tell you measurement of inventory, how we measure inventory for financial reporting purposes. Cost of the inventory there, they will tell you what amounts to the cost of the inventory and cost formulas used. You go through that, recognition as an expense, etc. Disclosure. You shall also be told how inventory is supposed to be disclosed in the what? In the financial statement. So 2 things that add value, good people. It's not even 14 pages because some of them are kind of blank. After that, you can then play with a head that is full of data or data. All right, let's go. Now, who IAS 37? Same story, same approach, even the IAS 10, IAS 16. If you're poor like me, you go there and say, okay, today I'm starting my PPE. You go to Google, you download that standard. Get it from the standard first, instead of hearing it as a rumor. Get it from the start. Go and read there, at least. When you come for class, at least when I say something, if you're going to continue today together, you'll be able to relate and say, okay, now I understand, I remember reading this, rather than to come here blank and hear something for the first time. Anyway, we'll still assist you pass, but now you won't be putting these things in your DNA. It will stay in the temporal memory. Right. IAS 37, good people, is going to tell us how we account for what? For provisions, contingent liabilities, and contingent assets. Right. Before they dive into the accounting treatment of this and that, they will explain to you. So IAS 37 is accounting for provision, contingent liabilities, and contingent assets. You might not be knowing what is a provision. They'll start by defining it. You might not know what is a contingent liability. They'll start by defining it. You might not know what is a contingent asset. They'll define it. And then they're going to tell you how you account for it in the financial statements. And we're also going to do the same in class. That's how it works, good people. If you want to go for your accounting, but if you are lazy, you're just going to be hearing these things in the corners and stuff like that, in the ranks, bills and everywhere, then you go and write about it. 37% will be coming for you, 27% will be coming for you, because it'll be evident that you are writing a rumor. You never bothered to study. You just heard these things as a rumor. A rumor cannot give you 50%. Okay, right. You are going to learn also about IAS 40, which is the accounting for investment property. Like I said, that these standards are very generous. And we are also what? Generous. I keep on saying we, because there are a lot of my colleagues here also on what? In this class. And there are also other tutors from other colleges who said, let's go and see how he teaches. I know how to teach friends there. Right. Anyway, so IAS 40 is going to teach us how to account for what? Investment property. Like I said, that this standard, good people, it will walk the journey with you if you use it wisely. You might be wondering, what is this investment property that they say they will be telling us how to account for it? It will define it. That standard is going to define it first. What is investment property? Sure. After I get that, what it is, they will tell you how to account for it. But investment property, loosely speaking, these are property. When you talk about property, you are referring to land and buildings. That is held for what? For either earning rental income, maybe office blocks where you guys work. Those are investment property for the owner, because he is earning rental income from those properties. Or this is a property that is held for capital appreciation, to say, okay, I'm buying this property. When the value of the properties go up, I will sell it. You are holding it as an investment property. But if a property, you are occupying it for the purposes of your activities, then we're going to say it is property, plant, and equipment. Okay, sure. And then we move on to another standard again, which is not that old, your IFRS 16. This is leases, right? So, but at our level, they are going to say we need to know the accounting treatment of what? Of leases only. The people who are what? Using that particular asset, not the owner of the property, right? Because what is a lease contract? A lease contract is a contract in which we have got the lessor being the owner of the property and the lessee being the user of the property, in return of what? Payment of consideration. Okay, so how do we account for a property that is leased? In the books of the lessee, because the syllabus, it states specifically that leases only. Again, if you're just going to go and ask someone, say, hey, please teach me leases, and you don't tell them that your syllabus requires you to only know how to account for leases in the books of the lessees only. They will teach you how you account for leases in the books of the lessor, and. Then you'll be having too much of a junk in your head. You go to the exam there, you want to force what you learned. Ziakad. Because you end up talking about Amali source there when it's not even in your syllabus. And the tutors, the marker would wonder, what is this student talking about? Is he trying to flex his knowledge that he already knows the things that they're going to do later on in their studies? But that will not give you marks. Okay. Another standard, not also very old, that's IFRS 15, which is revenue. Very long standard, right? It will teach us how we account for revenue, how we account for revenue, how you disclose your revenue and stuff like that. And this one is going to give you the 5 steps of revenue recognition, which you need to demonstrate. Now, it is in this module that it is started for the first time. So they will have to test a competence of this particular standard. This particular standard, it requires a lot of testing on the competence of the student rather than their technical ability. So that's why this standard is full of what? Of theory questions. They'll give a scenario, discuss whether the sale of tractors, the sale of TVs by X Limited should be recognized as revenue or whatever, when it should be recognized as revenue. It's going to be a long story there, which you need to what? To know your story. There are 5 steps for revenue recognitions. So I would take you through those 5 steps and say, if these 5 steps are made, good people, a company should what? Recognize revenue. Right. And then we have got a marathon of other standards for financial instruments, which is your IAS 32, your IFRS 7 and 9. Here we are looking at financial instruments. Financial instruments. Okay, so one of the topics that we are likely to do towards the end of the semester. But it doesn't mean that it's far from now. No, you guys are writing now in May, June, thereabout. And we are kind of technically we are in March. There's nothing much we can do for the next coming 2 days that are remaining in February. Right, so I've let you know about your syllabus, good people. You now know what you're going to be doing this semester. And this is what we're going to be taking you through. We're not just going to come here and start singing things. No, we are guided by the syllabus. Right. I'll try to mute and mute. Okay, so know your syllabus, good people. Don't run around like a headless chicken to say whatever textbook of accounting that you come across, you take it, you open it, then you start reading it. No. We want order. Accounting, it wants people with order. That's why even the financial statements are structured nicely. We know what we start with at the top, etc., etc., etc. How many times do we going to have a class per week? Okay, we will share the timetable with regards to that. But anyway, don't worry about the speed of covering and all that, isn't it? We have been teaching this module and kind of vibes. I know at what rate and how many times we should have this class in order for you to what? To finish the syllabus and be ready when the time comes. So just know that we're going to finish the syllabus and revise, and you are going to do well. So don't worry, say, he's talking slow. Are we going to finish the syllabus? Yes, we are going to finish the syllabus. And we are going to revise. Okay, so now what we'll do then for today, we need to see what is the word of the day? The word of the day, let me look at this. Oh, there's another standard. It's not a standard per se, but it is what we call the conceptual framework. It's going to be defining the elements of the financial statements, the conceptual framework, right? It comes with your theory. It's also part of your what? Of your syllabus. So the conceptual framework, good people. Like I was saying again, let's say you're poor like me. You can go to your Google conceptual framework, you download it, then you have it. So what are you going to learn there? The conceptual framework, we are going to look at our definition of the elements of the financial statements. Elements of the financial statements. They will define for you what the elements of the financial statements are. And now, good people, right, let me start here. As an accounting student, you must know what we call a set of financial statements, because these are the things that you're going to be preparing. So we are in this module to learn how to prepare a set of financial statements. A set of financial statements, it consists of 5 things there. It consists of statement of financial position, right? Statement of profit or loss and other comprehensive income. Statement of changes in equity. Statement of cash flows. And then we've got the notes. These are what the accountants do. This is what we're learning. We should be able to prepare this. And on the notes, one thing that you cannot escape before you pass this module is the PPE note. You'll be required to prepare this one, whether you like it or not, for a whole lot of marks, even up to 30 marks. Kind of 40% of the syllabus. Right. So that's one of the notes that we must what? Must know. Okay. As I attempt to mute there. So if PPE note, good people, is your card. You cannot survive it. You like it, you hate it, you have to do it. There. All right. So the word of the day. Let me see where I can start today. I'm not going to start with these funny theory things and. So the word of the day today, we can start. Let's start on that second item there. We'll go back to that one. It's just full of theory, and I need to be showing you some slides saying the financial statement should look like this, look like this. Okay, so but now to be productive, let me say today, the word of the day, it's inventory, which is IAS 2. Okay, right, the story of inventory. Remember now that our item element inventory, it is found here. Statement of financial position as current asset. It is found here in the statement of profit or loss and other comprehensive income, in the determination of what? In the determination of our gross profit. And our inventory, it is also found where? In the notes. Let me remove that one. It is also found in the notes, disclosed, where we need to show inventory of finished goods, where we need to show inventory being valued at Tonton there, which we're going to look at today. So inventory, it's a powerful element of the annual financial statements because it is found in 3 statements. That's why we need to learn how to account for inventory. Because if we are to account for it incorrectly, it means that our statement of financial position, it's off. It means that our statement of profit or loss, it's incorrect. It means that our disclosure of inventory is disastrous. That's why it was handpicked and said that students must know how to account for inventory. So now, at the end of the day, like I told you that, good people, this is assessment centered tutoring, meaning to say that we are enabling you to be able to do your assessment. We are enabling you to be able to write the exams. So at the end of the day, yes, the standards say this and that. At the end of the day, we need to know what is it that we are going to be tested. Because I know that's what you are interested in, isn't it? I've said a lot of things, but you might not be interested in that. Only that is in your mind is, what is it that we must do to pass this module? Okay, this is what you have to do to pass this module. Starting with what? This topic. We must know the learning outcomes. Learning outcomes of this module. Learning outcomes, good people, I am saying that the things that the students are expected to know, because what they are expected to know is what is going to be tested. Number one, definition of inventory. You can be asked to say, all right, they hold bottles of water, they hold TVs and stuff like that. XY Limited holds the bottles of water, TVs, etc. Then they say, discuss if the bottles and TVs held by XY Limited should be recognized as inventory or not. So where do you start? You need to know the definition of inventory. If this is a company that sells water, and that water is held for resale, then it must be held, recognized as inventory. If those televisions are from a furniture company, or the television is not from a furniture company, it is used in the office, then it should not be recognized as inventory, etc. Okay. Secondly, you must know how to account for inventory. How to account for inventory. In terms of IS2, because in accounting, we are not trading a case or whatever, or opinion. No. We account for things in terms of IFRS. What does the standard say? So even if you say, they failed me, they marked me wrong, I think I was right here. And you have to take the matter to the court for remarking. The judge will say, what does the standard say? How do you account for inventory? You would have said, hey, you account for inventory like this and that, saying strange things there. That don't hold water. You want to win that one. Okay. Accounting for inventory. There's something that we will be seeing from now onwards. It is a valuation of inventory. You have to know that. Disclosure of inventory in the notes to the financial statements, etc. Right. So, good people, e-accounting is about this. This is accounting. E-accounting, it's about, right, accounting for an element of annual financial statement. Now, if I ask you, how do you account for this and that? In accounting, we are referring to saying that now. I'm saying, tell me about the following. We are talking about, maybe I might mix up things, measurement. At what amount do I record this? Like, for instance, inventory. So on the measurement here, we must know the cost that that are to be capitalized as part of inventory. Right? So we look at measurement and the recognition. I think I've missed, maybe recognition comes before measurement, whatever, but yeah, and disclosure. Let's say for in the case of the inventory today, and the disclosure part. So that's what I would want to hear most. Are you able to say, how do we measure inventory? Law of cost and net realizable value. Do you know the cost that we capitalize to our inventory? Yes, purchase price plus any direct attributable cost. Sure. How do we disclose it in the books? We disclose it at the law of cost and net realizable value. Sure. So it is something like that. I'll correct this as we go, like this one, whether what comes first, it becomes a chicken and egg story. All right, so without wasting time here, let's look at it. So like I was saying, that let's say you are sitting down to start this on your own. You go there and download your IS2. You go through it like this. This is also what forms part of the learning outcome, what we have to learn. Right, let's start by definition. Everything begins with what? The definition. Here are the definitions of what we have to know. I might not be doing a lot of writing because I need to cover ground. Sure. The following terms are used in the standards with the meaning specified. So whenever you sit down to study a certain standard, you need to start on definition. Because at least now, after you have studied that particular standard, if we ask you at the end of the day and say, okay, what will you start? You are starting inventory. I'm likely to say, what is inventory to start with? Maybe you've got a boyfriend or a girlfriend who is a lawyer. They will ask you, what is inventory? And then now if you say you were sitting to study inventory and then they say, what is inventory? Then they say, I really don't know exactly what is inventory, but I can tell you how you account for it in the book. I'll say, no, you don't have to tell me. I believe you contaminate me. Because you can't say you know how to account for it, but you don't know the definition. So let's go. Inventory are assets. Assets. We all know are assets. Hence, inventory is classified under current assets. Held for sale in the ordinary course of business. Held for sale in the ordinary course of business. Or ShopRite, those things that you see there on the shelves. That's inventory because they are held for sale in the ordinary course of business. Inventory is sold. In the process of production for such sale, or these are the assets that you are holding because they are in the process of production, and after they are done being produced, they are subsequently sold. Let's talk about a property developer, Midrand. A lot of construction is taking place there. A property developer is going to hold the housing units as inventory. Those flats to a property developer, they are what? They are inventory. They are PPE. So those houses that you are seeing them at window level, roof level, and stuff like that, to a property developer, they are inventory. They are held. There are assets which are in the process of production for the purposes of sale. They will be recognized as inventory by that property developer. Sure. Or in the form of material or supplies to be consumed in the production process or in the rendering of service. Right? Material or supplies to be consumed. Like oil or stationery, we use them, right, in the production process or in rendering of services. If I'm to use some paper and stuff like that, if I was still having those quarter classes, writing on the board, those chalks and stuff like that, they are consumed in the process of rendering of services. I would account for them as inventory. Okay, so that's our inventory. So we've learned something new. Now we can define inventory. There. I'll put it for you there and I'll share with you. So this standard, you can get it online. Online, simple download it. Sit down, you study it. And take a break from TikTok. Okay, right. Let me do like this. Let me do like this. So I've defined what our inventory is. And there are other things there that are defined, which we have to what? To also have to look at. So all the definition could be whatever is defined in a standard. It is for a reason. It is for a reason. Because those terms you are going to subsequently what? See them. So let me finish with my definitions here. So that when these terms are subsequently used in the standard, we now know them. Net realizable value is the estimated selling price in the ordinary course of business, less the estimated cost of completion and the estimated cost necessary to make a sale. And I will tell you why we have a definition in net realizable value from Norway. It is because in terms of IS2 later on, they will tell us that inventory is the lower of cost. Okay, let me try to mute there. It is because while they are defining net realizable value there, I also have to answer questions here. Yes, the class is being recorded. Okay. Right. So what was I saying there? Oh, I was saying, why do they define net realizable value? It is because in terms of IAS 2, we are told that inventory is valued at the law of cost and net realizable value. So it means that when you value inventory, on your left-hand side, you should have the cost of that inventory. On your right-hand side, you should have the net realizable value. And whichever is the law of the two, you then use it. You then disclose it, or you value. That's the amount at which your inventory is going to be valued in the financial statements. All right, fair value. Fair value is the price that will be received to sell an asset or paid to transfer a liability in an ordinary transaction between market participants at the measurement date. Okay, don't worry much, because that is going to be learned IFRS 13 next year. All right. Like I said there, good people, that when we are accounting for something, I gave you that roadmap, how it works. We then go further. Let's look at the next thing that we need to know. As far as our inventory is concerned, the word of the day. Now, students are required to know the cost of inventory. You should be able to determine the cost of inventory. This is very key because it is a cousin of net realizable value. We say that inventory is valued at the law of cost and net realizable value. So now, if you can't determine the cost of the inventory, it means that you might incorrectly value it. Let's say you are handicapped as far as IAS 2 is concerned. You only know what a net realizable value is. You don't know what the cost is. When it comes to the valuation of inventory, you are likely to say net realizable value all the way. Yet you have to value it at the law of the two. We have defined what the net realizable value is, but we have not discussed what the cost of an inventory is. It's very easy for someone to say, it's easy, Musa, and the cost of something is the price that you pay for that thing. Yes, you are giving us a layman's definition, a strict definition that cannot make you pass the module. So here, even though we know what the cost of inventory is, even though we may know, so we're just going to humble ourselves and go and find out from IAS 2. What does IAS 2 say is the cost of inventory? Let's get it from the standard, because if you hear it from me, you may not take me serious. Inventories shall be measured at the law of cost and net realizable value. Measurement of inventory. You can have that here. Oh. Inventory is measured at the lower of cost and net realizable value. Okay. Let's go. Cost of inventory. One more time. Remember, in accounting, we record, it's a financial module. We record the rands and cents. So we need to attach value to that inventory. And now if you don't know what value to attach in that specific inventory, it becomes a problem now. Because how are you going to record it in the books? Are you going to say, hey, the inventory that I have is expensive, or it's not that expensive? No, it has to be quantified. So you must know how to quantify the value of inventory. And how do we do so? Let's humbly go to the standard. The cost of inventory shall comprise all cost of purchase price, cost of conversion, and other costs incurred in bringing the inventory to their present location and condition. So the cost of the inventory is the what? Purchase price plus any cost of conversion and other costs that are incurred in bringing inventory. Then I like to bring there. So it's actually referring to what? Direct attributable cost. If a cost is not to do with inventory, it cannot be tied to that inventory. It is not a directly attributable cost. It should not be capitalized to the inventory. So there we are. Ladies and gentlemen, the cost of inventory. Now let's put it in our English. So I'll say that the cost of inventory is the purchase price plus direct attributable cost. Right. The purchase price is easy to see or to determine. Sure, we are all going to get the purchase price, fine. But now, do we know what these direct attributable costs are? The direct attributable costs are the costs that are going to divide the class into two groups. Those who know what the direct attributable costs are, and those that don't know what the direct attributable costs are. But in purchase price, I doubt there's anyone who can miss it. So if you are given the list of costs, if it was bought for R2 and the following expenses were incurred, calculate the cost at which the inventory should be recognized in the books. We are all going to get the purchase price right. Right? If we are saying they are a reasonable person, not an insult. And the reasonable person will know that the purchase price, I think that's what we paid for this inventory. So obviously it becomes part of the cost. But when it comes to determining other costs that might be listed there, to say which ones are directly attributable and which ones are not, we then start seeing drama. But if I give you the purchase price plus any other cost, then I say I calculate the cost of the inventory, and you are not able to include a purchase price as part of your cost of inventory, then I'll say yes. This one, what do we do with it? It's gonna be tricky, you know? Do we tell you the truth that you must go and start political science or sound road? Okay, sure, let's go. I'm joking. Right. Cost of purchase. Remember, we said it is the purchase price. How many legs does it have? The cost of inventory, it has got purchase price, conversion cost, and other costs that are incurred in bringing the inventory. Those are direct attributable costs. They go on. These people love us. They never leave us alone. You will never walk alone. They go on to explain what the cost of the purchase price, the cost of purchasing. They go on to explain what the conversion costs are. They go on later on. They go on to explain what those other costs are. So the cost of inventory has got 3 legs. Let's have those legs in Excel. Here in class, I'm catering for slow learners. So don't say I will have understood. So I will explain things. If I need to draw a diagram, I will have to draw it so that it's what? It is cemented in your mind. Others are able to learn with pictures. Right, let's say cost of inventory. We have said that now it has got 3 legs, but one team. It has got 3 legs, which is cost of purchase. That is the purchase price, what you pay. It is the other one. It is the conversion cost. And we say here other costs. These other costs are direct attributable costs. Direct attributable costs. Right. So these are the legs in the determination of our cost of inventory. So it is some of those 3. So now if you are given a list of costs and then they say calculate the cost of the inventory there, in simple terms, they are saying, please identify the cost of purchase, which is the cost price. The cost price will be what you recognize. Cost of purchase, what you paid by. We are simply saying, identify the conversion cost that were incurred. We are also saying, identify the other cost. So then we embark on the journey of learning this cost. I'm not going to assume anything because I know the danger of assuming anything there. I'm catering for slow learners and those who are afraid to answer anything in class will be answered while you are seated there. I know it's not easy, isn't it, to question them. Right, now back to our standard. Let's get to know these legs. Better increase the speed a bit. Yes, all those standards, you can go download them, you find them. You're not going to pay for them. You'll get them for free. So no one can say, some of us failed because we are not privileged. We're not able to buy the standards. Who said you have to buy them? You can have them for free on the internet. Sure. Right. So our cost of inventory has got 3 legs. We have said, let's learn those legs. Number 1, we say the cost of purchase. The cost of purchase of inventory comprises the purchase price. Comprise the purchase price, what you pay, import duties. Import duties, these are the duties that you pay at the border if you bought these goods from what? From another country. And other taxes. These are non-refundable taxes. Well, direct costs are included here. Other taxes. Then we have got e-transport cost to bring your inventory to wherever you are, e-handling cost. If you are to pay courier company and whatever, you have to keep them in their warehouse. Other direct attributable cost, right, of acquisition of finished goods, material, or services. Then we say trade discounts, rebates, and other similar items are deducted in the determination of the cost of purchase, because these are not incurred. So if you are given a discount, say I'm selling you something for 100 Rand, but I'll sell you at a discount of 80 Rand. To determine at a discount of 20 Rand. To determine the cost of that item, you're going to say cost price, 100 Rand, less discount, 20 Rand. Therefore, the cost to recognize in my books is going to be 80 Rand. Sure. The conversion cost is self-explanatory, isn't it? These are costs that are incurred to convert raw material from one state to another. Convert raw materials to finished goods. The cost of conversion of inventory include the directly related to the units of production, such as direct labor. These are the wages that are paid to the people who are involved in the production process. The wages of AMA secretary, CEO, those people that don't work in the factory, that are not directly involved in the transformation of raw materials to finished goods, are not capitalized to the cost of inventory. Salaries of supervisors are not capitalized to the cost of inventory because those people are not directly involved. If supervisor is not directly involved in the production process, he is indirectly involved. That would fall under what we call those under what indirect cost. Okay, then we say other costs could be for the third leg. Other costs are included in the cost of inventory only to the extent that they are incurred in bringing the inventory to the present location and condition. For example, it may be appropriate to include non-production overheads of the cost of designing products for specific customers in the cost of inventory. Examples of costs excluded from the cost of inventory and recognized as expenses in the period in which they are incurred are. People, please, when you are reading, be careful. They give us a list of costs that are excluded. It's very easy for a student to say, okay, they are listing our costs, so these are the other costs that we include in determining the cost of inventory. They give you the list of costs that are excluded. So the following costs are excluded from the what? Determination of the cost of inventory. Number 1, abnormal amounts of wasted material, labor, or other production. So abnormal loss is excluded from cost of inventory. We expense it. So U26001 is going to help you in knowing more about these costs, that MSc module. So that MSc module, good people, it is not divorced from IS2, because that module teaches us how to value our cost. So if you're doing them concurrently, it's a plus for you. If you did it last year, it's a plus for you. But if you're able to do it next semester, no, I'm joking. We'll teach you, everything here. Storage costs are not included. They are not direct attributable unless those costs are necessary in the production before a further production stage. Administrative overheads. These are salaries of those people who think that they are educated, they are working in the office. You don't find them in the factory. That do not contribute to bringing the inventory to their present location and condition. Selling costs are not capitalized, or sales commission and stuff like that. They are not capitalized to the cost of our inventory. Okay, we need an exercise after this. It's not an ACT standard there. It's just meant to make you what? Feel better and have hope that you will pass the module. Okay, I'm joking. It's just exactly like that. All right. So we're going to do an exercise whereby we need to value our inventory. The recording is going to be shared in the group. So we are going to do an exercise how we value our inventory. In order for you to excel in that exercise, this is what you must know. You need to know that inventory is valued at the law of cost and net realizable value. IAS 2.9. You need to know this. And secondly, you need to know how you determine the cost of the inventory. And thirdly, you must know what the net realizable value is. So I'm going to remind you again there. Remember, I said I'm catering for slow learners. I'll repeat again. Besides, repetition is the what? Is how you can master something. All right, net realizable value is the estimated selling price in the ordinary course of business, less the cost incurred. Sorry, less the estimated cost of completion and the estimated cost necessary to make a sale. Let's keep that in mind and do the following exercise. We are going to value the cost of certain inventory items. See, we are going to value the cost of certain inventory items. Right, so the semester has begun, good people. That's how the semester goes. That's how the semester goes. It is the start of the semester. So, Isugi. Isugi. Okay, we have our company there. We have our company there. It says, so these are the typical kind of questions that you're going to be tested on, isn't it? At the end of the day, you have to be tested. And these are the typical kind of questions that you'll be tested on. As I say that this is a exam-based, this is an assessment-based kind of tutoring. If you want to be tutored for general knowledge, just to know why we will talk. Right. In the exam, you're told that you start with the required. Calculate the value of the inventory or product A according to the requirements of IAS 2. What does IAS 2 say? Inventory is valued at the law of cost and net realizable value. So we are going to calculate the cost of that particular inventory. So let's go. XY Limited manufactures product A for resale. The product A is manufactured for resale, so it's trading stock. Because by definition, we said that inventory is items that are held for resale. The manufacturing cost per product is 1350. Finished units of product A are sold at 1,550 per unit. The following costs accrued with the manufacturing of product A. So here's the story. Valuation of inventory. That the marker wants to see you. We said that according to the IAS 2, inventory is valued lower of cost and net realizable value. We want to know what amount are you going to be recording in that inventory, right? So what we are doing there basically now is to embark on the journey of determining cost and on the journey of determining net realizable value, and eventually giving our conclusion that 1 unit of product A should be valued at so much. Asambe, let's go. Let's go. Okay, now they've told us the manufacturing cost of the product is 1350. 1350 has been given to us as the cost of that inventory. We did not buy it, we manufactured it. Cost to complete inventories, 260 per unit. Packaging cost, 40 per unit. Advertising, 35. Salaries of administration staff, 1,000 per month. Those are not direct attributable because they've got nothing to do with our inventory. Yes, they are what? Period-based, paid per month. Admin staff, good people, these are the people who work in the office there. We think that they're educated, right? Or receptionists, answering calls, they don't come to the factory, say their oils and everything. CEO, CFOs, accounting personnel, marketing personnel. Sure. So that cost, we're not going to take into account. Sales commission, 90 rand per unit. And trade discount allowed, 55 per unit. The closing inventory of product A on hand for the year ended 31 December 20X9 amounted to 5,000 units. Calculate the value of the inventories according to the IS2. So what we're going to do now is we are going to value 1 unit, then we say times 5,000. So we're going to pick the right cost there between that. So we need to get to know the two first. Now, the cost of the inventory, we have it, but we are stuck on net realizable value. And me and my slow learner friends, I'm also a slow learner, I'm just a person who worked hard in life. Otherwise, I wouldn't have passed. So just treat yourself as a slow learner. Even if you think that just say I'm a slow, take things slowly, one thing at a time, focus, repeat, etc., etc. Where are you rushing? There's 24 hours in the day. Rushing to where? Go away. Watch TikTok, YouTube. Right. We have an issue with net realizable value. We now need to know what this net realizable value is and determine the net realizable value of that inventory for the purposes of valuing our inventory. So you can check it here. We are not in the exam. We read again. The net realizable value is the estimated selling price in the ordinary course of business. Okay, selling price, estimated selling price. We have our selling price there, 1550. Less what? Estimated cost of completion. What is the cost of completion? Is given there. Cost of completion of inventory less. I separated. Okay, I separated one as a one big box there. 260 rand and the estimated cost necessary to make a sale. So now you have to go and identify a selling cost here. To sell your inventory, it must be packaged, of course. You can't sell it without a packaging. So this is a cost that is necessary to make a sale. It must be sold in packets or whatever. So I separate that as well. Advertising cost is a cost that is necessary to make a sale. For you to push your units, you need to advertise. Yes, we're also advertising our class here with free classes. Right. Salaries of admin, I'll write it down, but then I'll have to give a reason. You don't just keep it. So this is not direct attributable cost or not a selling cost because I'm doing net realizable value. I need to indicate if I see it and skip it. The examiner cannot assume that, the student realized that the selling cost is salaries of admin is not a selling cost. He won't say that. He might say, he skipped it by mistake. If he had seen it, he was going to put it. So you can lose a mark there. Negative marking, they just go somewhere and say -1. But if I write it and give a reason, they say, this one saw that cost and he's got an understanding that it's not a selling cost. Hence, they gave a reason and it did not actually accumulate it with other selling cost. So you need to put it down. If it's not written, we assume that it's not known. Go, if you don't write it down, you say, the student feared his salary of admin's cost. It's got no idea of how to account for it. Skipped it. Sure. Sales commission, it's a necessary selling cost, necessary to make a sale. You need to pay someone a commission to move your units. Trade discount as well. The trade discount, it's a cost it's an opportunity cost. This is more of economic cost. You didn't pay for this, but it's something that you should have received, but now you're not going to be receiving it. So it's a more of economic cost there, right? We also also put it there. We come here and what? And subtract it. So now let me add together my selling cost there that we said we'll subtract, and I'll put them as negative there. So then I get my net realizable value there. This is my net realizable value. Selling price minus gross selling cost. Now I look at this cost, net realizable value. I look at the manufacturing cost. Whichever is lower, in terms of IS2, 1 unit is valued at the lower of the two being this one. Then I come here and say value of 500 units. It's going to be equal to 500 multiplied by this. Answered my question. We answered this question by way of principles. So here we'll teach you the principles that you need, which are the tools you need to pass. I'm not going to simply say, hey, take out your calculator. Let's calculate the value. This is a question, the exercise that I want us to do today. No, I'll give you the principles first, and then I take you through the what? The exercises. So that if you have to do something wrong, you need to say, but here, we are taught all these things. Then that way I can sleep peacefully at night, and you can wish me well. But if I don't give you the principles, and then now you are struggling to navigate your way out, you simply say, hey, that bastard wasted our time. What, 2 hours on a month end? I should have bought Jack Daniels and drank. Okay, so right, I will add this exercise also, good people. You repeat it. Remember, we said now, repetition is the art of mystery. Master. I was saying, pronounce it the way I was taught. I was never privileged to go to model A schools. So, master, I'll call it as master something. All right, I will connect with the other inventory stories when we eventually go through, but also I want to make sure that those that won't be attending, at least they get advantage, maximum benefit from this class. There are other things that we're going to be doing later on here, like valuation of inventory or FIFO and we're going to be connecting with those also. And those who are also doing 2601 MSc is going to be what? Double benefit, because I'll tell you about FIFO here, and you hear it about it somewhere else. It is C. All right. So this document, you would need it.
Let me also acknowledge the pastors here in this platform of end time group of intercessors.
Okay, gents, we're also in church, right? Pastors church, we're benefiting. Double benefit, you attend class and also get to attend church at the same time. We are serious. Class is free, church is free. What else do you want? What else do you want? You see that our package today, it's superb. Free class plus free scriptures. Okay, right. The next thing I want us to do it in 30 minutes. 1:45, we should be out of here. So, we're gonna say inventory valuation methods. Inventory valuation methods. Topic for another day. This one. I'm gonna teach you about your FIFO, first in, first out, your weighted average method, your specific identification method, but I will have to explain it a bit. This one. Only for good people died long ago. We no longer apply, inventory is no longer valued in terms of that. But maybe we'll check for purposes. It's no longer applicable. The standard is no longer doing this. FIFO died long ago. Last in, first out now. All right, if first in, first out, you are simply saying that the inventory that you bought first shall be sold first. Sure. Weighted average, our inventory in the warehouse is going to be valued at the weighted price. So you look at the price of inventory that was bought whenever we put it together, we get the average price. Then you multiply by the number of units in our stock at year end. Specific identification, you might be hearing for the first time, but here we say we have to trace each and every unit. Right? Like for instance, let's say like in a car, in a garage, our or BMW, they are not BMW, but a garage that sells vehicles. They use this specific identification method in valuing inventory. Maybe they've got equity. They'll say equity, okay, we bought it for R1. They go on to another one. Mercedes-Benz, we bought it for R2. So when they value their inventory, they are going to assign those values. So this one is applicable on those inventories that are not mass produced. But in the valuation of your Coke, your Fantas, your pocket water, those that are standard, you can use FIFO, and then you can use weighted average. For standardized products, you can use that one, that one. For those that are not standardized, you need to trace some cost. Like in a car garage. A Mercedes, we bought it for this much. So to value inventory, Mercedes is this much, Audi is this much, etc. So we shall come to that. And this topic is going to be what? Studied twice. I will teach you here on FSC 2601, and you're going to hear it somewhere else. Finance modules of yours. Sure. Okay, let's do the last thing for the day, another small topic, which I think we can start and close it. And then also, next class, we're going to look at allocation of overheads as well. And this is just that. So I also want to, I've partially taught you that. So don't go lying in the streets and say, you know inventory. I just gave you 60%. Don't lie to people in the taxis and say you can teach them inventory. I gave you 60%. Where are you going to get the other 40% from? You still have to come for class. Sure. Let's talk about this standard, events after reporting debt. There. Events after reporting debt. Who is 10 hood? Who is 10? Events after the reporting debt. After the reporting debt. Like I said, that I'm coming from the angle of a slow learner. I'm coming from an angle of a poor student. So what do I do? A slow learner, a poor student wants to start IAS 10. Where do they start? Are they going to blame their parents that they didn't have money to buy them textbook or what? No. They will simply go here and say IAS 10 download. Do that. They do that. They've got the IAS 10 now. They are now on the same what? At par with the sons and daughters of the rich. Because those that will buy standards, they'll be having this at a cost. So, okay, someone says slow learner is me. Oh, I mean, I'm also a slow learner, isn't it? Yes, so that's why I understand you when you are seated over there. Say, okay, I know he's lost. Let me repeat. See, I repeat without you having to ask me that, may you please repeat. Okay, where do we start? It's always on definition, because you can't do something that you don't know. You are getting ready to start your IAS 10, you will start on definition. So the student will come here on definition and say, what is this event after reporting debt? And let me first explain it to you with my broken English. Let me first explain it to you with my broken English. I tried it earlier also, right? Let's say a company has got a year end, like at 31 December 2025. This is the year end. Yes, it's going to be a tough year. It's going to be a tough year, yes. You have to run. You can't wake up tomorrow and have a decree. No. They are not, your institutions are not in the habit of dishing out decrees. You have to fight for it. And as much as we are teaching you guys to pass, deep down, I wish that you can fail. So that is not many of us. We have got degrees out there. Okay. That's the reality. Somehow I'll be saying, I wish the whole class can fail and come back next semester. We can make money. Okay, let's go. Events after reporting date. Okay, I'm not a satanist. It is. Okay, let's say this is your year end. And this is the date of authorization of financial statements. Where in management with this? Now, let's take you back to the basic, how so that you understand the dynamics of everything. The dynamics of everything there. The date the financial statements are authorized, authorization of financial statements. Here they will be signed by management after being prepared. Let's say the date is 28th 2026. I'll explain why we've got a discord in terms of those dates. What happens, good people, is that if the financial year end for a company is 31 December, like 2025, it could be any date. It will take time for management to compile the financial statements. And at some point in time, they will be compiled and they will be authorized for issue. Okay. So the period between this period, if I say this, let's see how it matches. There. This period, the period between year end and the date the financial statements are authorized by management. When the management sign them and say, "Sure, as I'm George," this is the period that we refer to as this is the period that is covered by the IAS 10. This is our IAS 10 period. So IAS 10 is going to tell us how do you account for the period that occur between year end and the date that the financial statements are authorized for issue. How bad? So obviously, it's also clear what they are going to test us. They are going to give you some events that occurred there or discovered there. And then they say, how are these events supposed to be accounted for? So let's put that down as a learning outcome. Let's put that down as a learning outcome because it's clear what they will ask us. Students should be able to discuss how events after the reporting date should be accounted for in the annual financial statements. It's no secret. And the examiner has got nothing against you, and the examiner is not trying to trick you because you already know what they are going to test you now. They are going to ask you, they bring in a scenario there, event that occurred there. For instance, maybe there was a building A. By year end, it was there. Then 4 January 2026, building A was struck by lightning. Then they say, hey, discuss how building A should be accounted for in the annual financial statements for XY Limited. It is an event after reporting date. So why are you going to start there to answer that question? You simply say that now. Building A was struck by lightning on 4 January 2026. This is an event after reporting date. Thereafter, you need to then connect. This is an event after reporting date as it occurred between year end 31 December 2025, and 28 February 2026, the date that the financial statements were authorized by management. So you're getting marks there. So even if you have to know that, you see, the way you start your answer, you look confident, and the examiner will say, yo, here is an A student. After that, you can then disappoint, show them a true color that I know nothing. You can then dramatize if you want to. But for introduction, please, at least, let's see that the building was struck by lightning after year end for January 2026, but before the financial statements were authorized for issue. Therefore, this event is an event after reporting date in terms of IAS 10. Then you say this event will have to be accounted for as then konap. Wololo. Yasuginganegwa. All right. Let's go. Definition. The following terms are used in the standards with the meaning specified. Events after the reporting period are those events favorable and unfavorable. It's not always going to be about a building that was struck by lightning. Sometimes it can be a favorable event, like they bought a vehicle after year end between 31 December and 28 February 2026. How should the vehicle be accounted for? Events after the reporting period are those events favorable and unfavorable that occur between the end of the reporting period and the date when the financial statements are authorized for issue. So in your answer, we need to hear this. When you are priming us, when you are preparing us for your good answer, we need to hear that. Oh, this event occurred between year end and the date that the financial statements were authorized for issue. Therefore, it amounts to an event after reporting date and should be accounted for in terms of IAS 10. Sure. Two types of events can be identified. There could be two types of events that can be identified there. Let's find out. Number one, event number one. Those that provide evidence of condition that existed at the end of the reporting date. And they are referred to as what? Adjusting event. Whereas 10 refers to those events as adjusting event. As the name indicates, those events that provide evidence of a condition that existed at the reporting date, they are referred to as adjusting event. So what that means is we have to adjust the financial statements for those events. We need to go and change the numbers. So in this case, let's go there. Let's say there's an event that is picked up during this region, the IAS 10 region, event after reporting region. For instance, let's say it's theft of cash. You discover it when you're preparing your financial statements during that period that there's an amount of 100,000 that was stolen. In November 2025, it was stolen somewhere there. In November 2025. So now, though we came to know about it after and during the IAS 10 period, this theft occurred during the year. So that's what that English is saying there. We have got one category, those that existed during the year. So that theft occurred during the year. That's an example of an adjusting event. Like they say here again, we repeat, there's slow learners. Let's go. Those that provide evidence of conditions that existed at the end of the reporting date. So as a year end year, if that 100,000 was stolen, it was already gone. After year end, we just discovered that there was theft, but this theft happened when? Yes. So the fact that we discovered during this period, it becomes an event after reporting date, but the fact that the theft occurred or the event occurred during the year, already as a year end, the event that occurred, we refer to that as the first leg, that is the adjusting events. Second, and those that are indicative of a condition that arose after the reporting period. And then again, during this period, you can discover some events that arose after year end. I gave you an example of a building that was struck by lightning or caught fire for January. That happened after year end. So that's a good example of what is being said here. Those that are indicative of a condition that arose as at year end, the building was still there. But after year end, before the financial statement were authorized for issue, gutted down by fire, struck by lightning, etc. So that would be an event after reporting date as well, and it shall be classified as a non-adjusting event after the reporting date. So obviously, also we see where this is going. As part of the learning outcome, we should be able to identify. So here I can say students should be what? Students. Because the examiner will not tell you that, hey, this is an event after reporting date. Students should be able to identify events after the reporting date. Should be able to identify, so, oh, this is an event after reporting date. So by you saying that, you've identified it. So if you're correct, you get the mark for that. And then after that, you should be able to say how they are accounted for. Okay, let's go. Then by pictures, events after reporting date. After the reporting date. That would be there. Always giving me a problem. Why not events? Events after reporting date. After the reporting date. Okay, fine. After the reporting date. Because it's at a point in time. So understand their English there. So we said that there are two events after reporting dates. Those that we say adjusting events, they arose. So they are indicative of a condition that existed at the end. Don't forget. As the name indicates, they will require us to adjust the financials. Straight there. Before we even get there, you can now know how to account for adjusting events. You need to adjust your financial statements. And then we said we have got the non-adjusting events. Non-adjusting events. So for this one, I can say that you know half of it. Why? Because you know that if it arose after year end, we don't have to adjust our financial statements. So this was, the entity does not need to adjust the financial statements. That's what you know so far. But they still have to do something, which we shall soon know. Okay, so as long as you know that it has got two legs there, you are better than someone who did not attend the class, who's yet to learn about this, to know about this in May. But, oh, you know what, now I know who Einstein, how some of us discovered it in February. When you were at the mall, Africa Mall, shopping because you said it's month end. You got paid. Sure. Right. That's the introduction. Let's go with our standard today. Everything is here, good people. So you'll be giving us money for nothing. Because these standards are with you, but you come and pay me this side instead of downloading. Now I'm joking, you try it, Yakshay. It's bad. Right. Let's go here on the accounting treatment. Now let's get slowly to the accounting part. Adjusting events after the reporting date. We now know what are these. So let's have a heading there. On the most important thing, we now go to the accounting part. Accounting for events after the reporting date. Remember I said, the learning outcome, you should be able to identify. How do you identify? By that definition, they're okay. And then the second part, I said that you must be able to account. Let's find out how you account for these events. An entity must adjust, okay, adjusting events after the reporting date. So these are indicative of a condition that existed during the year. At the reporting date, the condition had already happened. I gave an example of a cash of 100,000 that was stolen. How are we going to account for it? An entity shall adjust the amount recognized in its financial statements to reflect the adjusting events after the reporting date. An entity, yes, recording will be sent. An entity must adjust the amounts. So how do we account for those with adjusting events? I'm not going to repeat what the adjusting events are, is it? adjusting events. We are told there that an entity must adjust. So we need to adjust our books. So I'll give you an example there. Hey, accounting in journals, we can't run away. How then do we account for that loss of 100,000 good GL in our GL? We need to adjust by way of a journal. You are keeping your bank account internally, that T account, not the one on the statement. That one you can't do anything, the one that comes from the bank. It's a bank document. But internally, you'll be keeping also your record keeping from your 1502. So cash has been stolen. You have to adjust 100,000. So we can say here loss, profit or loss. We need to expense this loss. We'll say 100,000. And then we need to reduce our bank balance, but not the one at the bank. If bank balance is the one that you keep yourself, who general ledger. So now, if you skipped your classes for 1501, it's catching up. This is your color, man. Now I'm talking, it's immaterial anyway. So this is how you adjust. Now we are adjusting the amount. Remember, it says an entity must adjust. So this is how you adjust. You expense the loss, the 100,000 that was stolen, and you reduce the bank in the what? In the books, those internal books, not don't. Okay, right. That one for our friends. Okay, so we are told how to account for this. We are told, and we shall do exactly that. So that's what they mean. Just so we are going to look at the list of what, at the list of adjusting events, etc., so that you guys should know them, because it's not only this thing. It can be theft of money. It can be theft of what? It can be theft of inventory. You can also discover that here, you had one of your debtors who was owing you 50,000, and they died in October. So when you continue to carry their balance in the books month on month until year end. But after year end now, when you're going through that, maybe your legal personnel are now phoning, trying to collect the debt outstanding amount on your behalf. They come back to you and say, hey, that person was owing you 50,000. They say he died in October. So it means that we had already a bad debt as early as October, somewhere there. So that makes it an adjusting event, because at the reporting date, the debtor had already died. So how are we going to account for that? They said that in terms of IAS 10, an entity must adjust the amounts. So for that one, we need to come here and say bad debt. We expense it. It's an expense. The person was owing 50,000. And then say our trade receivables. They're an asset, less trade and other receivables. Let's reduce our asset. How do you reduce the asset? You credit the asset. Thereafter, you put your narrations in Tonton. So you see that now, the proper adjustment in the industry there, you are going to be adjusting by way of journals. Passing a journal, and then you go and adjust the books. So accounting will communicate mostly with journals. You cannot simply go in the books there and erase or reduce the amount and delete the previous amount of trade debtors and put the correct one. It will be seen as fraud. Any adjustment is done by passing a journal. So, and again, they started preparing you early in your life, in your career, about journals. When they were telling you, hey, this one assets increase on the debit and decrease on the credit, they knew that you would need this later on in your studies. So now if I say reduce trade receivables, you must know from your early career financial accounting module that, trade receivable is an asset. How do I reduce an asset? I have to credit it. Sure. Then we said that we have got two legs as far as events after reporting date are concerned. Then we've got non-adjusting events. We need to know how to adjust them, how to account for this. Non-adjusting events. Act like a slow learner. Go there and find out. Okay, yeah, the examples, good people. They even gave us examples. These people, they love us. They gave us some examples of adjusting events. Let's go back, let's retract a bit and go to adjusting event. The following are examples of adjusting events after the reporting date, after the reporting period. Here's some examples, good people. But keep in mind what the principle says. These are events that are indicative of a condition that existed at the year end. Here are some of the examples. Number one, the settlement after the reporting period of a court case that confirms that the entity had a present obligation at the reporting date. Someone was suing you. You had a lawsuit there. Someone was suing you, or you discover an amount that is being paid here as a court claim, civil claim of 15,000. You are management, and then you say, oh, this 15,000 relate to the court case, someone who sued us in July 2025. So it happened during the year. So as at year end, the court case was already existing. You had to pay that person. So that would be an adjusting event. You go and adjust that, debit your expenses and credit your bank. Another one. The receipt of information about after the reporting period indicating that an asset was impaired at the end of the reporting date. By the reporting date, the asset had impaired already. What is impairment? Tell you that maybe in April, one of the machine was already what? It malfunctioned there, and then it bent this and that. It's no longer able to operate it 100%, so you need to pay it down. There are examples. See, the determination after the reporting date of the cost of assets purchased or the proceeds of assets sold before the end of the reporting date. The determination after the reporting date of an amount, profit sharing or bonus payment, if the entity had a present obligation or constructive obligation at the reporting period. You see that now for adjusting event to say at the reporting, as at that date, this event should have occurred. The discovery of fraud or errors that show that the financial information are incorrect if those fraud and errors were perpetrated during the year. I gave you an example of 100,000. Okay, let's shift now to something. Non-adjusting events after the reporting date. Now remember what these non-adjusting events are according to the definition. These are events that arose after year end. As at year end, this event had not occurred, but it arose after year end. Good example, keep in mind building A that was burnt or carried down by fire on 4 January 2026. It happened after year end. So now let's find out how we're going to account for that building. What does the principle say? The standard says an entity shall not adjust the amounts recognized in its financial statements to reflect the non-adjusting events after reporting date. An entity shall not adjust. You don't have to adjust your financial statement for non-adjusting events, as the name indicates. But when they say that now, they kind of deserted us because they said we must not adjust. Is it odd? No, that's not odd. They will subsequently tell us. An example of a non-adjusting event after the reporting period is a decline in the fair value of investment between the end of the reporting period and the date when the financial statements are authorized for issue. Sure, that's one example. Oh, they didn't tell us how to account for it. Okay, they must tell us somewhere. Right, we read. The decline in fair value does not normally relate to a condition of the investment at the end of the reporting period, but it reflects circumstances that have arisen subsequently. A decline of fair value investment, right? Let's say you've got your crypto. The company was holding our crypto here as a year end. And then after year end, Donald Trump says something that will cause the value of the crypto to go down. So the going down of the value of that crypto or whatever share, Tesla share of what, it arose after year end. And because the driver there is something that occurred after year end. So it shall be an event after reporting date, which is a non-adjusting event. Okay, I'll read further. Therefore, an entity does not adjust the amount recognized in its financial statements for investment. Similarly, the entity does not update the amounts disclosed for the investment at the end of the reporting date, although it may need to give additional disclosure under that paragraph. All right, so I'm going to tell you. So here they were stingy. They did not tell us in black and white how we account for non-adjusting event. But I'm not going to do the same. I'm going to tell you. So they told us what we don't do, but we're not interested in knowing what we don't do. We want to know what should we do. What should we do? How do we account for a non-adjusting event? So the standard there, it fell short. Let me supplement it. Right. By definition there, these are the events that arose after whatever. An entity shall not adjust its financial statements for non-adjusting events. That one, sure. Non-adjusting events, if they are material, must be, it's not a suggestion, it's a standard. So it has to be accounted according to the standard. Yes, I'm using the word must and not should. And I'm not using the word could. First use those ones there with your English from what to measure in primary there. You might be meaning something to the marker. If, for instance, you say, oh, should or must are the same, can be a problem. Right, must disclose the non-adjusting events in its notes, in the notes to the financial statements, in the notes to the financial statements. Remember what we said at the beginning, a set of financial statements consists of 5 things. So am I adjusting events if they happen to financial statements there? Am I adjusting? You adjust, or whatever it happened there, you adjust. If it happened there, you adjust. If it happened there, you adjust. Sure. But for a non-adjusting event, it's not gonna touch any of these. It will be found sitting on the notes or in the notes to the financial statement. So non-adjusting events, they are disclosed in the notes. They will sit there. If we are going to find your non-adjusting events sitting inside any of those statements there, we are going to say the student did not achieve learning outcome number 1, which says that students should be able to identify events after reporting date. So what will the examiner do? He'll give you a chance to understand it by making you what? Repeat that module. So second semester, so the examiner loves you. If you write a wrong answer, they give you another chance to repeat. Isn't it? They won't put you in the bin and say you're not degree material. No. Another chance. See you next semester. If it's a year module, you fail it, see you again next year. So you have to do now that module in 700 days. It's a long time. So let's try to pass once, good people. Want to graduate. Let's go. Okay, non-adjusting events. Okay, we have said that. All right. Now, I don't want to repeat, but to repeat now, it's a second chance to understand something, is it? And you can also get to know other things that you did not capture the first time. And you also be helping the university with working capital as you are paying for these modules. I'm talking. Right. Now, here's the thing. You must know what to disclose. If we don't repeat people, the investment might close. It might run out of cash. What to disclose. Now, this is what you have to know what to disclose. Right. Because now, when they bring an adjusting event, let's talk about our building A. We say that it was gutted by fire after the reporting date. So you have to say, when they ask you how should the company account for building A, you need to say the building was gutted by fire after year end, but before the financial statements were authorized for issue. This event is thus an event after the reporting date in terms of IAS 10, is an event after the reporting date. Then you say, this event should be accounted for in terms of IAS 10. As it arose after year end, this is a non-adjusting event. The entity will have to adjust its annual financials. Sorry, the entity will have to disclose the event in the notes to the annual financial statement. The following must be disclosed. You also have to say what is it that they have to disclose in the notes. Because the notes, they are more explanatory. You are saying what happened. So now we have to understand what that story in the notes should entail. Because we don't have to end up disclosing things that are not necessary. So you must know what to disclose. The following must be disclosed. Number one, the nature of the event. The nature of the event, it be a story. To say that now, a building A caught fire on the 4th of April when one of the kitchen staff there caused an electrical fault. That's the nature, story. Make us understand what happened to building A. So we need that. Because sometimes they can say, discuss how the event should be accounted for. Or they can say, account for the event. If they say discuss, you need to say, oh, it's an unadjusting event, stuff like that, and the following must be disclosed. If they say prepare a disclosure of the event, I have to know what my disclosure should have, that paragraph custodian. One, it should have the nature of the event. So a complete disclosure that is going to earn you marks, it must have the nature, a little bit of story of what happened to the building A, it caught fire, and it was gutted down. What else do we have to disclose? The estimate of the financial impact. An estimate of its financial effect. Right, the estimate of the financial effect. So what then does that mean in rands and cents? If the company therefore suffered a loss of 13,000, the building at the current amount of 13,000, etc., etc. Now you want it to quantify. So for your answer to be complete, not to be a miniskirt kind of vibes, it must have rands and cents in the note if they say make a disclosure. That as a result, the company suffered a loss of, you say how much that building was worth, then that becomes the loss. All right. Hi, with that being said, God bless you. Or before that, let me hand over to my colleague to add what I forgot, if the colleague is here. And Ngobani, you can take over. I'm tired. I've been talking from 7 for free. Mr. Komo, if you're around, you can.
Right. Can you hear me? Am I audible? Okay. Okay. Right. I don't know if you can hear me. Mr. Lisani just put me off guard there. But anyway, can you give me a thumbs up if you can hear me? Okay, thank you. Thank you. All right. My name is Ngobani Nkong. I'll be also part of I'm also part of the tutors here at So Tutorials. So our institution normally specializes in accounting sciences. Since all our tutors are chartered accountants, uh, so we will be taking you for accounting. We've been in this business since 2014. I guess some who have been doing their first year with us, they still know us, and those maybe that are coming for other postgraduate